The topic I'd like to talk about is the concept of how the financial services industry hangs together. And if you take the South African industry as a starting point, the assets that are being managed on behalf of individuals in South Africa are in the order of 3 trillion rands, split across all the different types of investment products that people can purchase in South Africa. And the first starting off point we like to talk about is, where do these savings come from? What is the source of the savings? And in all economies, there are 3 sources of savings. There are individuals, citizens of the country who save. There are corporates, companies, who save some of the net profit after tax, and they will save that money or reinvest it into their businesses. And then the third leg of savings, of course, is governments. And governments typically will save in cycles. The saving is through infrastructure spend, as well as saving for future expenditure which they anticipate to come. So those are the 3 sources. We talk more about the individuals and how do individuals save. And the first starting off point is that individuals can decide to make their investment decisions themselves. So they can decide to buy, for example, a property, or they could buy direct shares on the stock market, or they could buy things like assets, hard assets, coins, Persian carpets, gold coins, works of art, and so on. But that's where the individual makes the decision to invest themselves. The second way that individuals will typically save is through a pooled structure. And in a pooled structure, what happens is the individual gives up the investment decision making. That is done by an investment manager. And the investment manager will offer products through a number of different regulated structures, and the ones in South Africa which are the key ones are the collective investment schemes, which are regulated, well-regulated products invested onto the stock markets here in South Africa and elsewhere. And the second big area where people save in South Africa is through life insurance products, and these are specifically savings products. So they are geared to allow people to save for retirement and perhaps for big events like education for children and so on. Clearly, investors need to look at the tax implications of the investment structures that they're in, and they need to decide which of these structures suits their personal circumstances best. But maybe the important point to note here is that with these pooled investment vehicles, the investor has given up the specific investment decision-making process to professionals. The other thing which we also talk about and share with people is it's equally important to save through protecting certain things. So, for example, life insurance products or short-term insurance products are also a form of saving. In the life insurance product set, you will typically be saving to replace income. So if somebody dies, that income is lost, and that's where a life cover policy would create a pool of capital, which could be used to replace the income foregone. Disability is the same. If you are disabled, you can't work, so an insurance product which pays out in the event of disability similarly is a saving, because it's replacing the income which you might lose while you're disabled. And then, of course, protecting assets, which everyone understands. Protect your home, the contents of your home, items of value, cameras, television sets, motor cars, these things. These are also a form of savings. And you may not need to call on them, but if there is a loss, to be able to replace the item without having to incur direct future expenditure yourself is also a saving. So when we talk about how the financial services sector hangs together, that's a very brief overlay. What we haven't touched on now is the concept of pensions. So where people are employed and they have a pension fund to which they belong, and the pension fund contributions made by the employee and often the employer are also invested. These are regulated products as well. That's also a significant source of savings for South Africa. But we really have spoken this morning more about the discretionary saving, where people make the decisions on how they'd like to spend some money that they've got. We do stress that it's important to have a philosophy that says you should save first and spend what's left, rather than spend and save if anything's left. A lot of our students ask us questions about advice. How do you find or decide which are the right products for you to take? or to investigate as a savings avenue. And it is difficult because there are so many products. There are over 900 unit trusts in South Africa. There are more unit trusts than there are shares listed on the Johannesburg Stock Exchange. So to know which unit trust to pick is very difficult. There are over 40 life insurance companies, all offering a variety of products, and to decide which company to choose and to decide which products to choose is very difficult. It's a complex matter. We believe that it is important for people to seek advice. There are a percentage of citizens who have the skill, the financial understanding and experience to be able to do this themselves, but they are by far the minority. The smart thing to do is to find an advisor, and there are strict regulatory requirements for South Africans to become advisors, so they are regulated. You can look on the Financial Services Board's website and you can see the registrations of advisors there, who they are. And there are certain professional qualifications they need to have. And once you've checked the skill set of the advisor, that is the smart way to actually work out how best to save that money which you do have available for savings.